Hello guys, welcome to another video. Today we are going to talk about internally constructed assets. I mean to say I'm going to talk about the capitalization of interest cost. Like most of the time companies what they do, they construct the asset for their internal use also, for their own use also. When you construct any assets like maybe the building, plant or machinery for their own use. Okay, so what you will do, you should capitalize the cost of material. You will also add the cost of labor which you will incur to construct that asset, plus cost of overhead, plus the cost of interest. So this is what we are going to talk about, like this portion, the interest capitalization, like when to capitalize and what should be the amount of interest which we need to capitalize. So this is what we are going to talk about here. So here you should remember here, guys, it's really important. So we can capitalize only the interest for qualifying assets, only for qualifying assets. So the qualifying asset mean to say these are the qualifying assets which you should remember here. So number one, the point number one is what the assets that are constructed or produced by the entity for its own use. Like if you have constructed any assets, okay, or if you have produced any product or assets for your own use, so that is called qualifying assets. For the qualifying assets, you can capitalize the interest cost. We have a second thing, the assets that are constructed or produced for the entity by the others. Maybe the other contracting company, they're going to construct a building for you, and this is the scenario here. And for that building, the deposits or the progress payment have been made. Okay, like you have made certain advance payment maybe. So if this is the condition, so this is also called your qualifying asset, and you can capitalize the interest cost. The third point, the assets that are constructed are produced for sale or for lease as a separate project. Like for example, it happens in the real estate also. Maybe you are going to construct the real estate certain buildings maybe. Okay, maybe you will sell those buildings, or you will lease out those buildings, but it is a separate project. So you, this is also falls under qualifying asset. Okay, so this is what is your qualifying assets. So now we have here non-qualifying asset, because when you will read the question, first you need to decide this asset is qualifying assets or non-qualifying asset. If you have any non-qualifying asset, please don't capitalize the interest cost for them. Okay, so here these assets are called non-qualifying. First of all, it will include the inventories. Inventories mean to say it is the routinely produced, okay, in the large quantities on a repetitive basis. Like if you are, if this is your ordinary course of business, you are producing these items, okay, and on the repetitive basis, okay, so this is your non-qualifying assets. So second point is the asset in use or ready for their intended use. Like if you have any asset which is already in use, or it's already for intended use, so then again it falls under non-qualifying asset. The point number three is what the assets not being used. Like if you have any asset, it's not being used in the earning activities, and that are not undergoing the activities necessary to ready them for use. And I would say you are not performing any activities. You are not performing any activities necessary to ready them for use. So if this is the scenario, of course, this is your non-qualifying assets, and you should not capitalize any interest cost. So here we have a rule, the interest cost, which portion of the interest cost should be capitalized. We will talk about that in the calculation. But here I'm going to talk about when the capitalization of interest should start and when it should end. So capitalization of interest should start if three conditions are met, one, two, and three. Number one is what? The expenditure for the qualifying assets are being made, like you have started to incur the cost. Okay, so if this is the first condition. Second is what? Activities necessary to make the asset ready for its intended use. Like you have started the activities also. I mean, say your construction is under progress. So if this is the condition, so you have to check the third one also. Plus you also incurring the interest cost. Okay, the interest cost is being incurred. So if these three conditions are there, from that period, you can start the capitalization of interest cost. Okay, and your capitalization of interest cost must end when the asset is substantially complete, if your asset is complete, or your asset is ready for its intended use. So you have to stop the capitalization of interest cost. Okay, sometime, maybe if you are constructing an asset, maybe you will suspend the activities, okay, for the construction of asset. If you have suspend the activities, so of course you should not capitalize interest cost for that suspended period. Okay, so here we go, guys. So now we have here, let me explain first steps in calculation, and then I will talk about the new note, exam related notes here. So this theoretical area we will cover at the end. Let's first complete the calculation, and then I will tell you these notes and you will understand in a better way. Here we go. So first of all, guys, so when you want to calculate the capitalized interest cost, so overall we can perform 5 steps. Okay. First of all, the step number 1 is what we have to calculate the average accumulated expenditure. So it's also called weighted average accumulated expenditure. Okay, accumulated expenditure. So how you will calculate that, I will show you with the help of example, but you need average accumulated expenditure. Okay, first, for example, I'm assuming here, let's assume it is $500,000. Okay, this is what is the average accumulated expenditure. And for that, this will be the format. We will write the date there when you incur that expenditure, what was the amount, multiply by outstanding period, like the date when you incurred, from that date till the end of the year, how much months were outstanding you will take. So this is how you will get average accumulated expenditure, and I will show you, don't you worry, with the help of proper example. So after that, for example, I'm assuming our average accumulated expenditure is $500,000. So in step number 2, what you will do, you have to calculate the amount which we are using from general borrowing. This is really important. For example, guys, if your average accumulated expenditure is $500,000, maybe you have taken specific loan to finance this construction, and the specific loan I'm assuming here, so you will subtract your specific borrowing, okay, which you have raised to finance this construction. So you will subtract the specific borrowing. For example, I'm assuming it is $100,000. So it means the remaining amount 400,000, which is the deficit, you are going to use from general borrowing. So this is what you have to calculate here. You have to calculate the amount which we are going to use from general borrowing, and this is the formula. General borrowing is equal to total average accumulated expenditure minus specific borrowing. So you will get the general borrowing. Okay, I will apply all these things through the help of example, don't you worry. So step 3, what you have to do, please, you should remember here, again I'm assuming here, just let me explain one more time so you should remember, because why we are doing this. So if you have average accumulated expenditure, let's assume $500,000, from there you will subtract the specific borrowing. For example, it is $100,000. So the remaining value you will get, of course, the amount which you will use from the general borrowing, which is $400,000. Guys, if you want to calculate the interest, okay, which should be capitalized, please, you should remember here, for the general borrowing, we are going to use always the weighted average interest rate, weighted average interest rate. Okay, so and for the specific borrowing, we will use the specific rate, of course, whatever the actual rate which you are paying, actual percentage of interest which you are paying on the specific. Okay, but the general borrowing, for general borrowing, we are going to use weighted average interest rate. So this is what I'm going to calculate, how to calculate the weighted average interest rate. So here we go. If you want to calculate weighted average interest rate, which we will use for general borrowing, so this is the format, just I put it here. So guys, so you need overall 3 columns. So first of all, you will write the general borrowing sources of finance. Maybe, for example, I'm assuming we have a bond 1, bond 2. This is the principal amount, 2 million, 6 million. I'm assuming only. Okay. So total borrowing is 8 million. So you will multiply with their actual interest percentages. For example, for this 2 million, we have an interest rate of 8%. For this 6 million, we have an interest rate of 9%. So if I will multiply with the interest percentages, I will get the actual interest cost, and I will just make the summation. For example, my actual interest cost is 700,000 and my total general borrowing is 8 million. Now I want to calculate the weighted average interest rate. How I will calculate? I will take actual interest cost, which is $700,000 divided by principal amount, which is 8 million. So if I will multiply, I will divide, so I will get what? Weighted average interest rate. And this rate I need to use for general borrowing. Okay. So then once this is also done, so step number 3 is done. So then you have to calculate step number 4. What is step number 4? You have to calculate the capitalized interest cost, like the interest cost which should be capitalized. Okay. In my example, don't forget I have assumed our average cumulative expenditure is $500,000. I'm assuming. Okay. We have a specific borrowing which is $100,000. Okay, and it means I am going to use 400,000 from general borrowing, which I have already calculated in step number 2, if you remember, right? So what I will do here, so if I want to calculate the capitalized interest cost, now I'm going to calculate the capitalized interest cost. What I will do, I will take this specific borrowing, which is in my example, $100,000. I will multiply with their actual percentage, whatever loan rate of interest, for example, your rate of interest is 10%. So I will take 10%. Okay. So 100,000 times 10%, so it will give me, for example, 10,000. Now I will take it a general borrowing. And general borrowing amount is, in my example, is 400,000 times, I'm assuming my weighted average rate. I need to multiply with the weighted average rate. I'm assuming it is, for example, 2%. Assume, huh? So one value you will get also here. So if I will add these two values, so the total of this is called capitalized interest cost. Okay, now guys, please you should remember here step number 5 also. So now you have to calculate the interest cost to be expensed, which you have to expense. For example, guys, if you want to calculate the interest cost which we need to expense out, so we need a total actual interest cost. It means I have to calculate actual interest cost. First, actual interest cost. So actual interest cost, how I will calculate? I will write all the sources in actuality, whatever you have. For example, here you have a source number 1, 2, 3. I will multiply with their actual percentage of interest. For example, whatever the interest percentage is there, this is how I will get the actual interest dollars. Okay. So this I need total actual interest cost minus capitalized cost, which we have just calculated in step number 4. The difference of these two is called the interest expense. For example, I'm assuming my actual interest cost is, for example, $100,000, but my capitalized interest cost, for example, is $20,000. It means now $80,000 I need to record as a expense. Okay, so this is what all these 5 steps I'm going to apply through the help of example. I hope just you understand the steps first. So let's do with the help of example now. So one by one we will go, guys. So here we have one company. Company constructed a building for its own use. Of course, it's a qualifying asset. A capitalization period begin on 1 year 1. It means at this date, 3 conditions were met. You started to incur the expenditure, necessary activities, like your work is under the construction also, and you are incurring the interest cost also. Okay, so it means from here you will start the capitalization of interest, and your capitalization of interest period is going to end on December 31st, year 1. I mean, so maybe the asset is completed here, or maybe it's ready for intended use. So this is your end of the capitalization period. So here we have a certain expenditure which we have incurred. Guys, here this information will be given in the question, like the date and the amount which you have spent or which you have incurred. Okay, these two things will be given, and you have to calculate this one and accumulated average expenditure also. Okay, so first of all, here we have a January 1, year 1, we incurred $500,000. So I have to multiply with the outstanding period. Okay, the amount of outstanding period for the outstanding period. So for from this date, from January 1 till the end of the period, end of period is 31st December. I mean, say when capitalization is going to end, it's 31st December, year 1. So it means from January 1 till 31st December. So you have how much months? 12 months. So I will multiply with the 12 divided by capitalization period, which is also a 12 total, I mean say months in a year. So you will take 12 divided by 12. So you will get total 500,000 average accumulated expenditure. Then you have incurred certain money on April 1. Okay. And you incurred how much? $400,000 from April till 31st December. How much months were outstanding? 9 months. I will take multiply by 9 divided by 12. So I will get 300,000 as a accumulated average accumulated expenditure. So again on July 1, I have incurred $600,000 from July 1 till December 31st. So how much money, how much months are there outstanding? 6 months divided by 12. So I will get again 300,000. Again on October 1, I have incurred 400,000 from October 1 till 31st December. We have 3 months outstanding, 3 over 12 will get average accumulated expenditure. This is how you will calculate, okay? And then you have incurred on December 31st, you have incurred $900,000, okay? And of course, from December 31st till December 31st, of course, you have a 0 month outstanding divided by 12. So this is, we will get 0 here. Just you need to make summation here of all these values. This is called your average accumulated expenditure. So this was our step number 1. Okay. Now, of course, in the question, you will also be provided with the data of a specific borrowing and general borrowing. So here we go. On January 1, year 1, Lisa specifically borrowed. This is specific borrowing. Okay. How much? 1 million. Now, please, guys, you should remember here, if your average accumulated expenditure is 1.2 million. So you have here minus specific borrowing, which is 1 million. So the remaining 200,000 you are going to use from general borrowing. So this is what is the step number 2, which we have done. Okay. So we need to know here the amount of specific borrowing and general borrowing. Specific borrowing is 1 million at the rate of 10% is the interest rate. Okay. Its other borrowing, I mean, it's a general borrowing outstanding during the entire construction period consisted of 2 million bond issued bearing 8% interest. So there's the one kind of bonds. And we have a 6 million bond issued bearing 9% of interest. Okay. All interest is paid at the fiscal year end. Accordingly, now you have to calculate step number 3, as I told you, weighted average interest, and how you will calculate the weighted average interest in step 3. Actually, this is what we are going to do now. Step 3, how to calculate the weighted average interest. Okay. Weighted average. So guys, first of all, weighted average interest you will always calculate for general borrowing. Okay, don't forget. And in the general borrowing, we have a two source, 1 and 2. So we have a 2 million principal amount. Okay, at the rate of 8%. So it's given here. If you will just focus here. So here we have here 2 million with the rate of 8%. And then we have here 6 million with the rate of 9%. I will take it 6 million and 9%. So once you will multiply, you will get the actual interest. Okay, 160,540 for the general borrowing. So your interest is $700,000 total interest, and your total principal amount is how much? 800,000. So this is the principal amount, 2 million and 6 million. So its total is 8 million. So now what you will do? You will apply the formula. You need a interest dollar, which is $700,000. You will divide it with the principal amount of the general borrowing, which is 8 million. Okay. So if you will multiply, you will get weighted average interest rate, which is 8.75%. Okay. So we are done with the 3 step. Now you have to calculate the step number 4, the interest cost to be capitalized first. Huh? So you can calculate that way also, or you can calculate the first actual interest. So here we go. Here first we are going to calculate the actual interest first, and then we will calculate the capitalized interest cost. Okay. So I mean to say I'm doing step number 5 first, and then I will do step number 4. Okay. So actual interest, how you will calculate? You need to put all your sources of finance. You have overall 3 sources of finance. You have a specific borrowing, which is 1 million times 10%. This is what your actual interest cost. Then you have a general borrowing. These are two your general borrowing. 2 million times 8%, 160. 6 million times 9%, 540. You will get $800,000 total actual interest. This is the step number 5. Now you want to calculate the interest cost to be capitalized, which was step number 4 in my explanation, guys. So here we go. You know, sorry. Here we go. So, total our accumulated average expenditure was 1.2 million. Okay. So this was the breakup from 1.2 million. We have a specific borrowing 1 million. Okay. It means 200,000. 200,000 I'm going to use from general borrowing. So now I just want to calculate the interest for specific and general. For the specific, you will use, of course, specific interest rate. So our specific borrowing is 1 million and specific interest rate was 10% given there. Okay. So this will give you $100,000. Then you have a general borrowing is how much? $200,000, which is the difference of average accumulated expenditure and specific borrowing, which is 200,000. You will multiply with the weighted average interest rate. Weighted average interest rate. Okay. So you will get how much? 17,500. So if you make the summation of these two values, which is going to give you 117,500. This is the interest cost to be capitalized. Interest cost to be capitalized. Now maybe you want to see how much interest cost you need to record as an expense. So you will take the difference of actual interest, which is 800,000, and the interest cost which we need to capitalize, which is 117,500. So difference of these two you will record as a interest expense. Okay, this is how you will deal with the internally constructed assets. Now let me just tell you a few exam notes, which is really important to solve the question. So here we go. We are moving to the notes now. Okay, guys. So first of all, you should remember for your CPA exam, it is important to remember two rules. Which two rules? Number one, rule number one is what? Only capitalize interest on money actually spent, not on the total amount borrowed. Okay. Forget about borrowed. So you have to see how much money actually you have spent from the loan. Okay. Rule number two is the amount of capitalized interest is lower off, is always lower off. Actual interest cost incurred, you have just looked at there, and capitalized interest cost. This capitalized interest cost is also called avoidable interest also. Okay. So then you have here another note which you should remember. This is another note. So do not reduce capitalized interest for what? Do not reduce capitalizable interest by income received on unexpensed portion of the loan. For example, if you have a total loan of 100,000, maybe you have used only $20, $80 is unused. So maybe you are going to invest this $80 somewhere and you are going to earn interest on that. Okay. So whatever the interest you will get, don't reduce your capitalized interest by this income. Okay, you are not allowed to do. Okay, and here we have another note: note not to exceed actual interest cost. Like most of the time your capitalized interest will be less than less than the actual interest cost. So this is how you will deal with the internally constructed assets. I hope guys it is clear. Thank you so much. See you in the next video. Bye bye.